On one side, you have the defensive and income assets. These aim to preserve capital and provide consistent income for you. And on the other side, we have growth assets. These come with higher risk, but have higher potential return over time. If you keep $50,000 in a savings account and you're earning 4% interest, you would make $2,000 per year, but inflation could erode your purchasing value over time. Bonds are more stable than shares. They actually pay a regular interest, which are also known as coupons. Some tax advantages with certain bonds just depends on where you are and how you actually invest in them. The company can double in value over a long period of time every year. A property, house, apartment is very unlikely to do that year after year. If you need stability, defensive assets make sense. If you want long-term growth, allocate more to growth assets. The trick, diversification. Hello everyone, welcome back to Elevate Your Wealth, and I am Victor, your host. And today we're diving into a crucial part that impacts every investor, and that is understanding asset classes. Not all investments, aka asset classes, are created equally. And knowing where your money is parked can be and make a huge difference between building wealth steadily or taking on unnecessary risk. So what we're going to do in this episode, we're going to break down this into two main categories so you can fully understand that. On one side, you have the defensive and income assets. These aim to preserve capital and provide consistent income for you. And on the other side, we have growth assets. These come with higher risk, but have higher potential return over time. And of course, we'll wrap up the session with a deep dive into risk versus return, because let's be real, understanding risk is everything in investing. So whether you're just starting out or looking to refine your portfolio, this episode is for you. So let's jump straight in. Okay, so let's start with defensive assets, or aka income producing assets. These are great for stability and income, but they typically won't increase significantly in value overnight. It's really perfect if you're looking for lower risk investments, so defensive assets works well. So the first asset we'll talk about is cash. Think about your savings accounts, term deposits, or money market funds. So what are the pros of cash? It is super low risk. Your money is safe, and the provider doesn't say we have made money, so we're going to share the profits with you. Okay. So simple and safe. It's also very highly liquid, so you can access your funds anytime, which just even makes it a good store of short-term value. It's very good for emergencies, and it can really help you with anything that comes up in the short term. So what are the downsides now? The downsides are very low returns, often lower than inflation. And if at all it's up to inflation, it's just slightly keeping up with inflation. It's definitely not for the long term. So just to give you an example, if you keep $50,000 in a savings account and you're earning 4% interest, you would make $2,000 per year, but inflation could erode your purchasing value over time. And the bank never comes to you and says, oh, well, we've made some profit and we're going to share this profit with you. Neither will they also come and say, well, we've actually made a loss and we need you to share the loss with us. So the next asset class is called bonds. Okay, so we can have different types of bonds. So we can have government bonds, we can have corporate bonds, and generally just other fixed income accounts, and they can be ETFs as well. So bonds are when you lend money to an organization, and this can be a company or government. For example, lending money to the US federal government, the Australian government, the Italian government, or even lending money to companies like Coles are examples of bonds. Now, what is the benefit of having bonds? Bonds are more stable than shares. They actually pay a regular interest, which are also known as coupons. Some tax advantages with certain bonds just depends on where you are and how you actually invest in them. So what are the downsides? Interest rate risk is a huge thing with bonds as well. When rates go up, bond prices can go down. Another downside as well is lower growth potential compared to shares as well. So just to give you an example, if a 10-year Australian government bond and you invest $10,000 and you're earning 4.5%, you get $450 on that annually, but that cannot or may not grow over time. So the next asset class is annuities. Annuities can be lifetime or fixed term payments. These accounts that are opened when you give money to usually an insurance company, and they promise to give you this money back at a later date or over your lifetime by regular payments. This can be really ideal for people in the latter stages of their lives and, can sometimes enhance the age pension. It just depends on what the objective is. So what are the benefits or what are the pros? You can get guaranteed income for life and or the fixed term period. It's really good for retirees who want certainty around their retirement. Some are indexed as well to inflation, which just means that it grows with inflation. So what are the downsides? Sometimes once it's locked away, you can't access your capital again, especially if you do the lifetime annuities. Sometimes it can be complex if you're trying to accomplish a certain goal. An example as well, a retiree invests $500,000 in an annuity and receives $30,000 per year for the rest of their life. They have that guaranteed return, but they cannot go back and pull out the $500,000 if the need arises. So one thing we need to do is we just need to manage the risk that actually comes with that, or not put all your funds into that. Okay, so what is another asset class? There's private credit and private debt. Generally, this is lending money to private companies. This is when you lend money to a private company and they promise to give you back that money at a certain time. These are not usually public, so not everyone can access it, hence the name private, and they come generally with higher risk. So what is the benefit? You actually can get a higher interest rate than the banks if you use these private funds, and they can actually help diversify your income stream. You're often less correlated to the stock market and don't have as much swings as the stock market. But yes, there are some downsides. The higher risk means that borrowers can default, and they usually work in such a way that default is passed on to you as well. So you're less liquid as well, which is not a good thing, but that means you can be locked in for a certain amount of years. An example is investing in a private debt fund that lends to businesses at, say, about 25% instead of a bank's normal rate of 10 to 15%. What that means is you can get 10% return, but that means that, look, you're lending to a group of people that have high risk. Now, let's move into the exciting world of growth assets. These have higher risk, but they also often come with higher potential returns and generally over the long term, over a long period of time. So the first one I'll talk about is Australia's favorite property. And property can be residential, commercial, and it can be a few other ones that I'll mention. But generally, these are physical properties that you can see and you can really walk into. So think about your industrial properties, and as I mentioned before, resi and commercial. These provide you with potential capital gains, and they can also provide rental income, and all of that makes up the total return you can get. People love property, and this is because it's common and, you can do well, but usually it's due to the leverage that comes with it. Okay. So most leverage assets can do well as long as you have the return to, as long as the right return to interest rate ratio is gotten. So what are the pros? Historically, property can give you long-term returns. Okay. It's very easy to leverage property. So what that means is you can borrow against the property, and generally you get rental income, and that can provide passive cash flow for you. So what are the cons? Well, so you have high upfront costs, stamp duty, legal fees, and all the setup costs that come with it. You can also be in a situation where it's illiquid, so it's not very easy to sell and get your cash when you want it. Market fluctuations can really impact the value as well. So for example, buying an investment property for $800,000, renting it out for $3,000 a month can be beneficial for capital appreciation, but it comes with some risk as that being empty or you not having to get your money when you can. Moving to the next asset class, so we'll talk about infrastructure. So infrastructure, you have things like your toll roads, your railways, airports. These are large physical projects that are usually put in place by the government and a private company. And these are usually because they are needed in the communities to help improve standard of living or just provide, what people need. So what are the benefits of this? So they provide stable and long-term returns, okay? And generally as well, they come with a income yield. Okay, so that means they actually pay out some distributions. Sometimes they're, well, most often you're less volatile than shares. But what are the downsides? Sometimes they can be very sensitive to interest rates. And sometimes it's very hard for retail investors to be directly invested in them. An example is investing in an infrastructure ETF that owns a stake in airports, toll roads, and energy grids. I like to use the example of a toll road, and people can relate to this. Once you drive past the toll and you hear the beep, your people making money and invested in that. The more people drive through the same road, and the more profit is made. And generally, what happens is the more valuable that road actually becomes, which means capital growth on the road as well. Now, moving into the next asset class, shares and equity. So this is one of my favorites as well. So they're usually publicly traded stocks. And this is when you own a portion of a company, which is referred to as equities or shares. And this is when, you have that share and it can grow in value because the company also grows. Generally, what this means is that you share in the growth of the company, which is amazing. So what are the pros? Generally, you can have higher long-term returns than all the asset classes I've spoken about. And it can be liquid as well, which is good. So depending on your time frames. Generally, these come with dividends as well. And that means you get a regular income. So what are the cons? It's highly liquid, and this can lead to large losses. And this is generally if you invest in just one share versus spreading the risk. Generally as well, it requires time and knowledge to manage. So an example of what this can look like, buying $10,000 worth in the AXX 200, which can grow by 8% annually on average. That would actually turn into $21,589 in 10 years, and that's you doing nothing. So it's also worth just comparing this to property, because people love property. So they're like, well, Victor, why wouldn't I just go and buy property? And I like telling people as well, the company can double in value over a long period of time every year. A property, house, apartment is very unlikely to do that year after year. So the notion of that property always does better than shares is not true. The real benefit is that property is very easy to leverage, and you can use that as a home as well. So what I do is I always encourage people to consider using both to build wealth versus one or the other, because each has its own pros and cons, and when you put them together, it just works amazingly. So what is the last asset class? So we have alternatives or derivatives, and think about your crypto, your hedge funds, your options and commodities. Generally, just zoning into alternatives, they're anything other than what I have mentioned above, as they don't fall into one class or the other, okay? These also include things like private equity and commodities, like I've mentioned, like your grains, metal, or oil. We have the other asset class called derivatives, which are derivatives, and generally the name comes from the derived value from one of the other asset classes that I've spoken about. So generally, they're very complex, and and it's very important to understand what you're getting into, but they're huge potential gains. So what are the pros? It diversifies risk from traditional assets, which is good. You can get potentially higher returns than all the asset classes I've mentioned before as well. And it can be a hedge against inflation, especially when you think about gold and crypto and all those. So what are the downsides? High risk and very high speculation. Complex strategies as well. So for example, option trading is very hard to understand. What is an example of a derivative? It's buying an option to provide you with the opportunity to buy a certain asset within a certain period of time. This asset can be to buy shares on a company like CBA or Amazon. You can also invest in a small company that is not listed on the stock exchange, but it's a small company, and what that means is it comes with risk, but they might be raising money to either get more team members or serve their clients better. And that is an example of a private equity account. Okay, so now risk versus return. So this is important because every asset class sits on a spectrum. Okay, so you have your low risk and low return items like your cash and your bonds. You also have your medium risk, medium return asset classes like your property and infrastructure. Then you have your high risk, high return asset classes like your shares, crypto, and derivatives. So generally, what happens is the higher the potential return you can expect, the higher the risk as well. Okay, I've heard people say that there is a safe investment that is giving them 20% return, and I've explained that the risk is definitely embedded in that asset. Even though yes, you might get 20%, but it means that it usually comes with a higher risk. So it's probably advised that in such times you do your very due diligence. The best way to measure risk is to compare it to any potential return you would receive. And what I like telling people is you can do that with something like the cash rate. The higher the amount compared to the cash rate, it means the higher the risk. If this starts to get into double digits of the rate, be sure that is a very risky project or asset you are backing or investing in. Your investment strategy should reflect your risk tolerance. If you need stability, defensive assets make sense. If you want long-term growth, allocate more to growth assets. The trick, diversification. Having a mix of both to manage risk while growing wealth is actually a great outcome. All right, so that's a wrap on today's episode. I hope you've got a clearer picture of which asset class can be used to park your money and how they actually fit into your strategy. If you found this valuable, subscribe and share it with a friend who needs to start investing. If you want a one-to-one strategy consultation, book a free chat, and that way we can actually guide you as to what should be done. Until next time, keep making money work smarter and harder for you.